In this video, I'm going to demonstrate differential analysis using problem 144 as an example. So the setup is we're a consulting company. This is our current income statement. A firm has approached us wanting some consulting work for their managers, and we're trying to decide, is this going to be profitable? So basically, we're looking at what's the differential cost relative to the differential revenues, because certainly we don't want to approach it if it's not going to end up making us money. So I'm going to start out and read through here, and it says if we take on the contract, we do need to hire an additional full-time consultant. So current labor costs were 239,400. Again, I don't need to look at the total after I make the change. I just need to look at the change itself, and they're indicating that the consultant is going to be 85,000. So that's going to add 85,000 to our labor cost. We read through here and it says the equipment lease is going to increase by 5%. Now, I will say it later says we don't need additional space, so I'm not exactly sure why the equipment lease is going to need to increase, but we're just going to go with it. So all I need to do is take our existing equipment lease cost of 35,280, multiply it times 5%, because again, we're looking at the difference, and that's going to be an additional cost of $1,764. Obviously, with this new consultant, they're going to need additional supplies, an additional 10%. So take our supply cost of 22,680, multiply it by 10%, and again, additional supply cost of 2,268. The only additional cost that's increasing is other. So again, take our initial cost of 15,960, multiply it times the 15% increase, and that gives us an additional other cost of 2,394. Now we're going to add up all our additional costs or differential costs and 85,000 in labor, 1,764 in equipment lease, 2,264 in supplies, and other costs of 2,394 means an additional cost or differential cost in total for answer A of 91,426. Now, that's the extra cost. We compare it to what the revenue or what the contract's going to pay. They tell us in B that's going to be 90,000. Ultimately, the revenue is less than the cost. So 90,000 versus 91,426 in cost means that this would reduce profitability by $1,426. Now, knowing nothing else in the scenario, we just know the quantitative stuff here, not the qualitative stuff of would this lead to something profitable later, but knowing nothing else, we would definitely reject this.